Good afternoon. Thank you. Yes, I see some people in the Q&A in the chat. That's great. Thank you for saying hello. My name is Sarah Mayu, and I'm here from Temple University Small Business Development Center. And this is QuickBooks Advanced, which is the third webinar in our QuickBooks series. And if today is your first time on with us, no problem at all. Maybe you just needed the advanced session. Either way, we're happy to have you if you are new, or you can repeat for the series. If you're completely new to Temple SBDC, we are part of a nationally accredited network of small business development centers that are funded by the federal government, by the Small Business Administration. And they're also hosted at local universities and funded at the state level. So Temple University is located, Temple University hosts Temple SBDC. You could probably assume that based on the name. And we cover Philadelphia, Eastern Montgomery, and Lower Bucks County. But there are actually 16 small business development centers in the state of Pennsylvania. And since we are offering this statewide, you might be online from Scranton, Pittsburgh, down in Westchester, wherever you are. We are more than happy to have you on here for this session today. A couple quick administrative items. We are recording the session. You will get a copy of the video in a follow-up email within 1 to 2 business days. And you will also get a copy of the PowerPoint so you can review all of the great information we'll be going over. For those of you that were joining a little late, or just to repeat, for those of you that heard me right as we started when we were getting on, there is a lot to cover in QuickBooks Advanced. So in a second, I'm going to toss this over to our guest speaker, Connie, who will go over the agenda of what we will be spending the bulk of the time on today. But if there's something specific that you wanted assistance with, or that you were hoping to get out of this webinar, please do feel free to put them into the chat or the Q&A. I will be reviewing those throughout the session, just so we can see if we have the time to go over some of those things as well, because there's a lot in Advanced QuickBooks, right? So we're going to cover some big items today. And if there's anything else, if you can put that in now as you're thinking of it, if you had something on your mind, it'll help us inform what the rest of the conversation is going to look like. So without further ado, I'm going to have Connie Mitchell get us started here with QuickBooks Advanced.
Well, thank you, Sarah. I'm Connie Mitchell. I own Mitchell Business Services. I provide bookkeeping services. I've been doing this for over 20 years, and I work mostly with QuickBooks online. I do have a few clients with other programs, the QuickBooks Desktop, and another one using Sage. But my favorite thing to do is teach people how to use QuickBooks. So I'm thrilled with this opportunity. And like Sarah mentioned, there is an awful lot of material to cover, and we only have an hour. So please put those questions in the Q&A as soon as possible, and I will try to work it in, even if it's not, part of the agenda for today. So again, this is the little slide about me. Today's topics, we're going to cover how to do a bank reconciliation, learn how to record and pay a loan, how to record owner draws and contributions, and time for questions and answers, and especially sign up for the hour after the class that we can do private office hours. And I can answer your questions one-on-one if we don't get to it during this 1 hour class now. So the first topic is all about bank reconciliations. This is where you are reconciling the money that's showing on your balance sheet in your cash accounts as compared to the money that's showing on your bank statement. So there's an actual process within QuickBooks Online that I'm going to show you how to do that. That is really the process that I say I hang my hat on this, because it's what needs to be done to make sure that the money, even though it might not be categorized right in your financial statements, at least you know the total cash figure is correct. So then the next step would be actually looking at those reports and maybe adjusting where things are categorized. But this bank reconciliation part is where you're making sure at least all those financial transactions are at least entered into your books. Just quickly checking on the Q&A, says from Rhonda, sales tax entries, category set up and paying out. Sales tax is something that when you're setting up your items in your items list, you're determining at that point whether they're a taxable item or not. And then there's another place within QuickBooks where you're identifying the taxing authorities and the rates and who you pay, and making sure that those are the reports are coming out correctly. Or it's a troublesome area within QuickBooks. I've seen complaints about the sales tax portion of QuickBooks really not doing things correctly. So you really want to drill down into the details of the sales tax process and make sure that it's set up correctly and that it is working correctly. I'm going to go through, these are instructions that I'm going to go through now. I'm going to jump into the actual live version. I'm going to pull up the sample company of QuickBooks Online, but these are the instructions for what I'm going to do. I'm going to click on that gear icon, click on reconcile. We're going to enter in the ending date and the balance that shows on your bank statement. Then you start reconciling. The process of reconciling is really just ticking off each item that appears on your QuickBooks and appears on the bank statement. And at the end, when the difference is 0, that's when you click that finish now button. And I still get excited when I get to do that. It's my little celebration I get to do. Call me weird, but I like it. So, and this is what that screen will look like. The reconciling screen, this is a screenshot of a reconciled bank account now that it has reached this 0 difference. So let me stop. I'm going to stop the screen share for the PowerPoint, and I'm going to jump in to the online. So the sample company for Craig's Design and Landscaping Services, that you can actually even just Google QuickBooks sample company, and it's not too hard to find this. QuickBooks also offers a free 30-day trial. So you can always jump in and play around with QuickBooks if you don't already have it. Or even if you do have it, it's a place to kind of test out some theories. If you're not exactly sure how to do something and you don't want to mess up your own books, you can't mess up the sample company. It will always revert back to whatever Intuit has set up as their database. So here's where this gear icon is that I was talking about. And under tools is where you click on reconcile. And so since this is a sample company, it's coming up with the getting started screens. But it's still gonna get us to the point where I can at least show you the basics of how the mechanics of reconciling the bank account works in QuickBooks Online. So you're choosing which bank account. So in this sample company, there's only 2 bank accounts. There's the checking and the savings. But if you have a PayPal account or some kind of online banking account, even a petty cash account, you would set up the account, and this account type is the bank. There's other accounts that you can reconcile, these credit card accounts. It's the same process where you're taking an outside statement, and practically every account on your balance sheet will reconcile to something outside your own books. So this process is really the same. So you're going to choose, say, the checking account. This ending balance would be, and I'm just going to throw in a $3,000 figure and say the ending date is today. And I would say, okay, start reconciling. So it's going to bring up the list of everything within that date range and all the activity that has transpired and has been recorded in your QuickBooks Online. And there's moving things out of the way so I can see what I'm doing here. This right-hand column, that's where you're looking and you're saying, okay, my bill payment of $300 is in my books, and I'm going to check it off if it also cleared the bank, and this deposit of $175, if it also shows up on my bank statement. I'm clicking all these things. If something's on the bank statement and it's not in your books, then that's a sign to add it, or to double check and make sure maybe you didn't add it to the wrong bank account. So maybe it's a boo-boo that you need to fix. And I always say bookkeeping starts with the letter BOO for boo-boos, because that's a lot of the work, is finding and fixing errors and just drilling down to make sure things are accurate so that these end results, what you want to get to, these financial statements, are correct. So this is the process. Just tick, 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 tick everything that's in your books. If it's on the bank statement, you're ticking it. If it's not on the bank statement, you're adding it. If it's in your books and it's not on the bank statement, then if it's a check, maybe it's a check that's outstanding, and that's okay. That's a difference between your books and the bank balance. That's what you are reconciling, and you're identifying what that difference is. If it's a deposit that's in your books, but it's not in your bank, and it's more than a couple of days old, then it's a problem. You've recorded a deposit and it really didn't make it into that particular bank account. So again, it might be a mistake that needs to be corrected, or it's a snafu that you need to research. Bottom line, once you get this difference item to 0, that's a good signal that you've done everything right. 2 other numbers to double check if you're having a problem getting to this 0 difference is this total deposits figure. That will also show on your bank statement. So the total deposits for the month would be your figure here, as well as your total payments for the month would match your bank statement. Your beginning balance should be the same as your beginning balance on your statement. And again, your well, I'm reversing it here. Your ending balance is what you keyed in, and your beginning balance is what you started with. So I'm gonna stop sharing and do a little check-in here on the questions.
Yeah, Connie, I think we have one question at the time that's relevant to this topic. And then, like we said, I'm glad that people are putting in questions for other things as well. Maybe we'll just save those towards the end. But Elisa did have a question about reconciliation that I think is good. And she said, how do things end up on the reconcile screen that are dated before the month you are reconciling currently, even if you successfully did it the month before?
Excellent question. That would mean it's something that's outstanding. So if you wrote a check 3 months ago and they never cashed it, it's still going to show as an open item on your reconciling screen, because at some point in time, they're either going to cash it or you're going to give them a call and say, hey, did you lose the check and whatever. But anything that's old has happened. It just hasn't cleared your bank. Or it's a mistake that you just need to research. You need to circle back around to something that's on your books that hasn't cleared the bank. And maybe it's a duplicate entry. And so those outstanding issues are important to research and understand, because they'll throw off your bank balance. And if they're a truly outstanding item, then that's the answer. That's why there's a difference. But if it's a problem and you haven't researched it, then that could be something that's been ignored, and you don't want to do that. You want to know why. So that's a very good question.
All right, great. I think that's it on bank reconciliation for now. And then thank you for those other people. We'll hold on to your questions till the end.
Okay, thanks, Sarah. All right, so I'm going to jump back to the PowerPoint and share my screen again. Okay, and I'm going to close out the questions box. So, okay, so the next topic that we're talking about covering in this advanced hour is a loan application that has been approved. So you've decided, for an example, you want to buy a truck for your business. So this is kind of the scenario that I'm using, so I can show an example to you. So we're going to talk about how to record that loan, and there's kind of several steps to the process. And again, these are the actual instructions. I've got them on the slide to help you after the webinar, but at least it's written down for you. But I'm going to show you too. I'm going to jump back into the QuickBooks Online and show you. We're going to actually click on the new button. We're going to start with a journal entry, and we're going to record the purchase of an asset, and then create the new liability to set up the loan. And then the next part is actually going to be making a payment on the loan. So so this is what I'm going to jump into. And as a matter of fact, I don't even like the way Intuit does this. The sample company is showing that there's a, and I'll show you how they have the truck on the balance sheet recorded at $13,495, and then they credited an opening balance equity account, which I really don't agree with. I don't like. I'm going to show you a better way. So I'm stopping the screen share on the slideshow, and I'm going to go back into QuickBooks Online. So we're getting out of the reconciling. I'm going over here to new. I'm going to create, well, let me first, before I do that, let me first show you, since we're on the sample company, what I'm kind of talking about. On this balance sheet, there's a truck already listed, like they bought the truck for $13,495. And the way they got that truck on the balance sheet is this journal entry. And by clicking on the balance sheet, I just drilled down into a transaction report. I'm going to click again on the journal entry, and I'm coming down to the journal entry form. So it's kind of a roundabout way, but this is the advanced class. This is how you maneuver in QuickBooks and how you change things if you don't like things. So I don't really like this opening balance equity. What I want to see here is the loan account. So I'm going to put in here a new account, and I'm going to say this type of account is a long-term liability, and I'm going to call it the new truck loan.
Connie, would you mind if I pause you for 1 second? Someone asked a really great question, and I'm hoping that if one person asks, it might mean a couple other people have it too. If you could just explain the purpose of a journal entry in general.
Okay, so in QuickBooks, the beauty of QuickBooks is that it's automating all the back end debits and credits of all these financial transactions. That's the bookkeeping piece where you're recording everything in a double entry set of books where everything has a debit and a credit. And a journal entry is, and this is just, I'm saving and closing the adding of the new account. But this journal entry is, I'm debiting the asset called truck original cost, and I'm crediting the new truck loan for the same dollar amount. So that's a journal entry. That's the bookkeeping piece that typically when you write a check, you're debiting an expense and you're crediting cash, but the form itself looks like a check. So QuickBooks is trying to take away the confusing bookkeeping aspect of accounting and making it in the simplest form possible for a business owner to be able to do their own books without even needing an accountant. Their marketing is so good that a lot of people really believe you don't need to know any accounting. I disagree. I think you do need some guidance, especially in the beginning in setting up your business. And even at this point, when you're creating a new loan, you might want a little bit of guidance from a higher level accountant, from your CPA, the person that's going to be helping you actually prepare your taxes, help you make decisions for tax strategies, ways in which you can maneuver the money in your business to your advantage, understanding those laws, which they change every year. So does that answer the question, Sarah?
Yeah, I think so. So the journal entry is more manual, right? A lot of things in QuickBooks are automated, but if you had to add something in like a truck, when you made that purchase, it
Yep.
didn't automatically go into your QuickBooks account. So you have to add it in manually as a journal entry.
Correct.
Great, perfect, thanks. On with the truck example.
So I'm going to save and close this. It's warning me it's already been reconciled, I know. So then it's taking me back to the next blank screen for a journal entry, and I don't want to do anymore. So I'm going to close this screen too. And I'm going to come back up here to this. It's defaulting back to where we were. I'm going to go back to the report summary, and I'm going to show you now that original truck is still on your balance sheet as an asset. But now we also have in the liabilities this new truck loan for the same amount. Okay, so there you go. You bought a truck, you put it on your balance sheet. It's an asset. It's also a liability because you got to pay it back. So then the next step is how you're going to make a payment. So we're going to go back into new, and there's lots of ways to make payments. I mean, you can use your online banking, you can write checks, you can write expenses, you can enter bills. And if you were in the beginning class, you'll know I talked about this expense and check is a one-step process where you're recording the expense and you're hitting cash, the bookkeeping behind these transactions. In the bill and the bill payment scenario, if you do it this way, it's a two-step process where you're actually setting up an accounts payable. So you would be entering the bill and then paying the bill later. For the purposes of this class, I'm just going to say we're just going to write a check to pay the loan. So I'm going to click on this check and it brings up the check form. So again, behind the scenes, this check form is actually going to debit and credit. It's going to do the bookkeeping behind the scenes for you. You don't have to do the journal entry by filling out this form. It's going to do the journal entry for you. But I need to fill it out. I'm going to say, all right, who am I paying? So I'm gonna set up an actually a new vendor because I just bought the truck and now I have to pay the truck loan company. So whoever it is that you owe now, that's going to be a new payee. And so you can set up the details of this new payee in here. You can, if you're actually going to print out a check, you can add their address so that when you do utilize that vendor, it will pre-fill the address and print on your check for you. And then there's a lot of other information you can track on your vendor if you care to. So shoot, I didn't save it. So new truck, no, I said truck, truck, RUC, truck loan company. All right, so I'm gonna say I'm gonna add it. I'm just gonna save it. And you put in the date, put in the check number. If you were going to print a whole lot of checks at one time, you would check print later and then print them all at the same time. But down here is where you want to think about how you're distributing that money. Say you owe $425. 400 of it would be going towards the principal, so it's going to relieve that liability, and $25 of it is expense. So here under category is where you're going to choose which account from your chart of accounts. And so we set up a new liability account, and we can scroll through here, or we could have just started typing it. And new truck loan is where I'm going to say, I want to pay $400 on my new truck loan. And I can put any kind of description I want. This is an optional field, but you can say, okay, this is the principal portion of my $425 payment. The next line is interest. So it's not even coming up interest expense, it's interest earned. So the interest expense account's not there. So I'm going to add that to interest expense. I'm going to add that, and it's an expense account, or yeah, the account type is called expense. And this is important. In this account type, this determines which report things are going to be on. So your balance sheet accounts will be your bank, your assets, your liabilities, your equity, your profit and loss report, or your income statements. Those accounts that are the type income and expenses, that's how QuickBooks knows which report to put it on based on what you say the account type is. So I'm just going to close it. I want to expense, so INTEREST and $25. So here, up here, you can see the total amount of my check is going to be $425, yet I've broken it out into two places. $400 is going to reduce my liability, and $25 is going to increase my interest expense. So save and close. So that's how I'm going to make a payment on that truck. Again, this original cost would be the same on the balance sheet, but then this truck loan, it went down. And if I double click on that, we can drill down and we can see, okay, we started with the total loan and now it's starting to reduce with the check payments. I'm going to pop up to any questions you think I should answer now, or are we saving them for later, Sarah?
Yeah, we have a couple good ones here. Someone said, what if it's an ACH transfer?
Okay, that's a good question. So an ACH, what I do is I put in, I use a check form, but I type ACH. and that's it. It shows on the bank register as an ACH. It shows on the reports as an ACH. That it's just like a check, only it's the reference number changes to ACH.
Great, perfect. And then someone said, let's say you paid cash for the total cost of the vehicle. Would you enter things the same way? And I'm thinking the answer is no, because you don't have to worry about interest.
Right. Then you would go back to the way Intuit set it up. So say it's your own personal truck and you want it to be contributed to your company, then that original journal entry would have been right, where they debited the asset for truck and then they credited the opening balance equity account. So there's no payment. So if the owner is just contributing, if you paid cash out of the business, excuse me, then you wrote a check and it's debiting the truck asset and crediting cash. You're skipping the whole loan process and paying the loan process.
Great, that's what I figured. And then I'm not sure about this one, so you let me know, Connie, if this is something we might get to at the end or during an office hours, or if it fits here. But she said, once you have the truck, how do you measure the depreciation of the value over time?
I skipped that part.
Yeah.
That's advanced, but that's a very good question. Part of the process of bookkeeping is depreciating assets. And so based on the life expectancy of an asset, you're allowed to expense it. So instead of it just sitting on your balance sheet, you would have that $13,000 original cost, but then every month you could expense a little bit of it, and it's called depreciation expense. So on the balance sheet, that accumulated figure is called accumulated depreciation. And so that original less the accumulated depreciation and the net figure shows on your balance sheet. And then on your income statement, each month you're able to realize a depreciation expense. And by doing that, you're reducing your income. And so then you're reducing your tax liability. And the reason for that is that a business is going to have to replace that truck. So you need to expense it and recognize the savings that that affords you so that you'll be able to then buy another asset to replace that once that useful life is over. So that's the kind of thinking behind it. That there's depreciation expenses for buildings. That's a topic for your CPA, for those higher level accounting professionals. But whoever asked the question, that's a very good question.
Great, thanks. And yes, the person who asked that, also, I'll be posting the link to our open office hours after if you want to drill down a teeny bit more with us in terms of next steps on that. But yeah, I like what you said, Connie. It's an advanced. That's I'm glad that you even knew what
you're getting beyond my pay grade.
All right, great. I think we're good to move on for now.
Okay, good. So the next topic, let me stop screen sharing so I can come back to the slides. Share. Okay, so moving past the journal entry for the truck. And we talked about going in and actually making the payment. So these are the instructions, how we did that. And we mentioned that there's the two amounts you need to know is the principal and interest. And then this is the picture of the actual check form. All right, so the next topic is owner draws. So you're basically just writing a check to yourself. We're going to go into that new button. We're going to click on check. The payee is going to be your name. We're going to select owner draw. It's an equity account and save and close. So you're going to print yourself a check. This disclaimer down here is this process may differ depending on how your business entity is structured. So for a closely held company, a sole proprietor, it's your business, you're filing a Schedule C, it's rolling up to your 1040. This is how you do it. If you're a partnership or if you're a corporation, then you need to check with your CPA or the person that helps you with your tax planning strategies and understands the laws, because you may be required to actually take a payroll, have a minimum required salary based on your job description. You know, if you're in a partnership, your partners aren't going to appreciate you just dipping in there and printing checks to yourself willy-nilly. So with that said, this is how you do it. And in the equity portion on your balance sheet, I recommend having the two accounts, the one's called owner draw, so that you can keep track of the monies you've taken out, and also have another one in there for owner contributions. So when your business is getting light on cash and you need to contribute, you're not going to make the mistake of depositing money to your business account and mistakenly consider that as income, because that would then be taxed. So you don't want to be taxed on money that you contribute to your own business. So it's an important piece of bookkeeping knowledge if you're doing this for yourself. And you know, if a lot of small businesses have help at the end of the year with a CPA, this number, you want to make sure you go through all your deposits and double check that they're all income or owner contributions and or loans. You may have taken a loan out from the bank and gotten that cash influx into your business. It's a common mistake that those deposits are recorded from the bank statement as income. That's a mistake. So in the advanced class, I'm throwing out there the common mistakes I've seen in my experience that just asking you to slow down and make sure that things are recorded properly. So let me stop the screen share here. So I get off the PowerPoint and I go back into the actual online so I can show you what I'm talking about. Again, it's basic. If you're going to write a check to yourself, right here, it's going to be your name. So you're writing a check out to you. And this category probably won't be there. You add it. It's called owner draw. And we're going to add it. And it's not an expense. It is an equity account. So it will appear on your balance sheet. So we'll save and close it. And you can just say owner draw or whatever, you know, if you want to put a reason why you took money out of there and say you need to take $500 out. You know, you can print this out. You know, if you've done the ACH transfer, however you you know, take the money, you would record that there in this check number, this reference field, and save and close. So if I go back to our balance sheet report, there's our $500 that we've taken out of the equity. Pretty simple. Same thing with the owner contribution. So let me stop sharing. Any questions here I need to look at there?
Yeah, someone said if a cash, I'm sorry, I want to make sure I say this right. If a cash owner withdraw, then would you put the check number as cash? I'm not sure if I asked that correctly.
No. If it's not a check, if it's not going to come out of the checking account, and so you would actually have another account called cash. If you have a petty cash account, you know, if you're not using checks, or if you're not using your debit card, or if it's not in the bank, if it's in a box and it's cash, it's called a bank account within QuickBooks. Does that answer?
Will Delise, if that did not, okay, she said yes. Great, perfect.
Okay.
And then this might be a next step when you're done with this, but how would you record a line of credit would be maybe next up on the list.
Okay. A line of credit is similar to the new truck loan in that instead of adding the asset to truck under fixed asset, the asset you're actually getting is cash. So if you got a line of credit, a bank loan, you're actually going to get the cash. So you would be able to debit cash and you would credit that new liability account called bank loan. A line of credit is like getting a credit card with a balance available. So you don't need to record it until you use it.
Great. And then would you just put it under liability accounts, right?
It would be like your credit card account. You would set up a credit card, and that, let me show you real quick. We would come under, actually, to set up a credit card account, you don't use the new button to set up a credit card account. You come under the gear icon. You're going to come to your chart of accounts. And we're going to do a new account because it's a credit card account. So that sets up the account for you to use, right? So I'm going to save and close that there's a credit card. Then you would go in and you would use the expense. So you used your credit card or you used your line of credit. So you're going to say under my expenses, I paid Home Depot for materials, right? If you're a contractor. And my payment account was my credit card. So say I'm buying materials for the job, say, and I spent, $6,000 and save and close. So if I go back to my reports, my balance sheet, so now I can see I have a credit card account. So that would be the same thing as a line of credit. Instead of calling it credit card, the new account would be a liability, just like the truck loan, only you would call it line of credit. So, but you want to set it up so it would be under this liability section. A line of credit. Again, the chart of accounts, go into new, and it's a long-term liability, and we're going to call it line of credit. And there you have it. So again, you're gonna choose when you create an expense. All right, so you can't use line of credit to actually pay for something, but you would be able to transfer, say, funds from your line of credit account to your checking account, that type of thing, or write a check. You could write a check from your oh, you can't do it. You could do it. Sorry. If you had to get money from your line of credit, you'd have to go to the bank, and then you're going to add it as a journal entry to increase that line of credit account, just like a loan. And then you're going to pay it off just like you were paying off that truck, by writing a check or setting it up as a bill or having it coming out automatically out of your account. But you still need to create it, whether it's an ACH. It's just like writing a check within the QuickBooks. Did I confuse you, or did that answer you?
I think that explained a little bit of line of credit and how you'll get it to show up on the books. And then, Sean, if you had any follow-up questions, please do let us know. We can maybe show you in more detail in the office hours how to set something like that up as well. But I think, Connie, you covered the basics of where you would put it. And a line of credit, yes, is from a bank, and it is a liability. You would be paying it like a credit card. I know we were on owner draws, so I don't want to stray from that.
Well, we owner draws, and then let me stop share here and go back to the slides. We were getting into owner contributions. So we're going to click on the new. We're going to actually select a bank deposit, and there's a section of that called add funds to this deposit. We're going to choose owner contributions, enter the amount, and save and close. So I'll show you how to do that.
All right, great. Yeah, and once we go through that, we just had a couple more questions on that whole credit card and how you pay things down, and I think we can round out on that after we finish with the owner contribution.
Okay, so we're going under bank deposit, and say we're going to put it right into the checking account. We're coming down to the add funds to this deposit. We're skipping over the payments portion of this bank deposit screen, and we're choosing the owner contribution account, which isn't there. So I'm going to set it up OWNERGRIBU. So owner contribution, I'm going to add that, and it's not an income account, it's an equity account. And so I'm going to save and close, and say we want to put in $5,000. So we're going to save and close. And we'll jump back over to the reports, your balance sheet, and the cash account went up $5,000, and the equity from your owner contribution went up $5,000. So that's how it's balanced. It has nothing to do with your profit and loss. It's just you put money into your business. And I compare that to putting water in the pool, because you have to have cash to even be in business. So that's my story, and I'm sticking to it. Cash flow, it's all about cash flow. And, you know, it's very common for the owner to need to contribute it. And then, you know, from time to time, the owner is going to take it out, because that's what owners can do, especially in the sole proprietor. And again, all this is different if you're a more complicated structure, you're a corporation or you're a partnership. You may be required to take payroll. You may be putting money in a, you know, a lot more structured fashion than the way I'm describing here. So I'm going to stop screen share and then come back to the slides. So that was owner contributions. And this is how it resulted on the balance sheet. I showed you that. And that's it. Those are all the topics that I thought I could cover in an hour. It's a lot, especially, you know, if this is new to you. This is the tip of the iceberg. Go back to the SBDC and ask for more clarification on things that you don't know. And thank you for this opportunity to show off my knowledge.
Yes, thank you so much, Connie. We did warn you guys, right? So there's a lot of topics. So I think you covered some really good ones there, Connie, that people who are more advanced stage of business might be maybe not even considering yet. For some of you that aren't familiar with finance, you might go, oh, now I have to remember to put owner contributions in, you know, things like that. So there are quite a couple Q&A, and I want to make sure that we can answer all of these.
Yeah.
But first and foremost, I just have two quick things I want to say while we have a couple minutes here. The first is we have a survey that we ask that everyone fills out. We are required to have a survey after all of our webinars. It's only 4 questions. It's really easy to answer, and it'll help us know what you liked, what you didn't like, what kind of webinars you'd like to see in the future. So please do take the time to fill that out. I just put that in the chat. And then secondly, we did promise that there are QuickBooks office hours. So we only have about 10 more minutes here. And we are more than happy to sit down and answer questions for those of you that are with us. But if you want to speak with Connie one-on-one, or you have a very specific question that maybe doesn't fit the scope of a webinar, please join us at the Zoom link I just put in the chat for our office hour that starts right at 3 o'clock. So we look forward to seeing some of you on there if you want to talk about something specific or something that we couldn't get to today. There is a lot to go over in QuickBooks Advanced. So Connie, I did already let you know a little bit. We had 3 or 4 people come in with the same question. So I think this is the first one we want to tackle, which is how do you record payments on the credit card? So if you're paying down your credit card.
Yeah, I see that from Wadalia Soto Arcasia. I'm sure I didn't pronounce it right, but I was just looking at that question. Paying down the credit card. So let me go back to sharing the screen, and we can look at that credit card, because then we have that. So here's a $6,000 balance showing on our balance sheet that we owe the credit card company. So if you want to make a payment on the credit card, you could go in here into new, and you could write a check that you're going to mail to the credit card company. And you're going to say, you know, whoever that is, and then you're going to choose which checking account you're going to pay it out of. Then the category here, you're making the payment on your liability. So here's where, now your credit card. So you're paying the credit card company, you're taking the money out of your checking account, you're paying down your credit card, and say you want to pay $1,000. So we'll save and close, and we'll go back, and we'll see that the credit card balance is now $5,000. Now, when you're hovering over any of these numbers, and the blue line comes up, that means you can drill down and see the detail behind the number. So we'll see that the $6,000 created the total liability on that credit card. And then the next item is a check where we made a payment. And so now the new balance on that credit card is $5,000.
All right, great. And then a follow-up to that, she said, how about under other, I think, maybe she's meaning the other option, recording a payment as expense or using the pay down credit card option in QuickBooks.
I don't think I understood that question.
Yeah, I'm not sure I did either. I'm sorry, Will Delise. If you want to try putting that back in the Q&A and clarify, do let us know. I want to make
Here
sure we can
How,
answer
I was
that.
trying to find it myself. How about under other? What will be the right way to do it? Recorded as an expense or using pay down credit card option? Yeah, I'm not sure.
Yeah,
I
when you click the
understand
new
that.
button, she's saying. So when you click
Okay.
new, I guess she's saying there's other and then pay down credit card. So is there a difference there? Yeah.
Oh, pay down credit card. Okay. I clicked on it. What came up? Pay down credit card. Okay. Record payments made to your balance. Which credit card did you pay? Okay, so I haven't seen this screen before. Quite honestly, I haven't used it. So somehow you made a payment on your credit card, so your balance is less. And so you're doing the same thing that I just did on that check form, except now this is doing it with a pay down credit card screen. And so you're not actually cutting a check to mail it to them, you're just recording it. And what did you use to make this payment? So the drop down options, it's still asking you, well, you know, what account did it come out of? What date did you do it? How much did you pay? So it's recording it in a different manner.
Yeah, it looks like it's kind of the exact same thing, but maybe QuickBooks added this so you could find it faster.
Yeah.
And same thing for both of these, whether, I know a lot of people don't pay credit card with check anymore. Like Connie went over earlier, it would be from your checking account, but it might be an ACH, not a check number, which we talked about.
Right. And QuickBooks is really trying hard to make this easy for people to use. And so maybe a lot of people just would rather pay down the credit card and select something that just says pay down a credit card rather than trying to determine, well, should it be an expense? Should it be a check? Should it be a bill? You know, to make it less confusing, Intuit decided to put this as another option. There's 8 different ways to do the same thing all over the place in this program. It's so easy. Sometimes it gets confusing because I'll show somebody how to do something one way, and then someone will say, well, I do it this way. And I'll say, well, that way works too.
Yep. Great, great. Someone said, we give our employees prepaid cards, like a PayPal. How would you set something like that up?
Okay, that's a good question. So a prepaid card in PayPal. PayPal is actually set up like a bank account. So
Yeah, I think you meant just like a
you would have your
PayPal.
PayPal accounts up here listed for your employees. And then you're going to fund it. Somehow you're going to transfer money into PayPal, and then you're going to record how those payments out of PayPal, you know, were they expenses? What were they being, why were they spending the money? What was it being spent on? How do you want it recorded in your business bookkeeping? So it's another bank account. PayPal is just another bank account.
Great. Someone said, how do you enter owner's contribution if it was made in the past?
You would date it back. So you would go back here to owner contribution and backdate it. But that's going to mess up, you know, if it was back before you did a reconciliation, that could create bookkeeping issues. But that's just a common issue. when, like, if I'm brought in the middle, I mean, very rarely do I get brought in and it's when the business first started. So a lot of times it's kind of cleaning up and getting beginning balances straightened out and reconciling and reconciling until it's right, and coordinating with the prior year tax return and the accountant, and getting anything that's prior. You it's date driven in QuickBooks, but you have to be cautious if you're using a back date prior to when something's been reconciled, because then you're going to mess that up.
Mm-hmm. And most people reconcile on a monthly basis, you would say. Yeah.
I highly recommend paying your bills and looking at your money every week and paying attention to your reports at least once a month and reconciling every month all these different balance sheet accounts, reconciling. And even on a daily basis, if money is coming and going, check your online banking and make sure that there's no fraud happening on a daily basis. It's that prevalent out there right now to need to keep your eye on it.
All right, perfect. So we're coming up at 2:59. I know there was one or two other questions here. They were a little bit more specific. I don't want the attendees to think I didn't see them. But if you want to, please do just hop over. I put the Temple Zoom link right here. You can just click it and it'll push you out of our webinar here and push you right into the office hour where you can join Connie and I, and we can just answer those really quickly for you. I do appreciate everyone's time here today with us. Like Connie said, there's a lot going on in QuickBooks, and I appreciate her efforts to put some advanced topics together in an hour. Hope that was of all value to all of you on the call. And if you had something more specific, that's why we have these office hours. So please join us. My clock is saying exactly 3 now. So we're going to end the session here. And please do join us at the office hours. Otherwise, enjoy the rest of your day.